welcome to this video training. Now in this video I'll be talking and sharing about liquidity and market structure. Now we have an extensive training video here in this YouTube channel where we talked about a whole lot of other things, including the ICT fair value gap, how to identify valuable order blocks and all of those. I will leave the link for those training in this video for you. Now, if you're joining us for the first time, this is Golf Course Academy, and here we talk about everything related trading in financial markets and profitably so. Now, a lot of persons, a lot of traders do ask, Jay, what is the one important thing to identify in the market? How can I become a profitable trader? And without thinking, without mincing word, the first thing I tell them is understand the concept of liquidity. Now in this training video, I will try as much as possible to narrow in down on what liquidity is and how you can trade liquidity. Now this obviously will be a training series, and so if you are not subscribed to the channel just yet, please do where to hit that subscribe button so you'll be the first to get notified when I upload the next series of training on market liquidity. Now what is liquidity? Liquidity simply means money. Liquidity is equals to money. And take liquidity like the fuel that drives the market. So without liquidity in the market space, there will be no volatility, and therefore there will be no opportunities. So liquidity equals to volatility, which also equates opportunities. And so the first thing to know is that without liquidity being taken in the marketplace, there will be no market volatility. So what is liquidity? I have said liquidity is money. Liquidity is likened to the fuel of the market, and it's important to know that price moves from one level of liquidity to another level of liquidity. Price moves from liquidity to liquidity. So how can you identify liquidity? How to identify liquidity? Very easy. I will try to keep this video as short and precise as possible. Liquidity, first of all, is resting in psychological points in the market. When I say psychological points, what I mean is, for example, if the market is in a downtrend, then liquidity rests above swing highs in a downtrend. If the market is in an uptrend, then liquidity rests below the swing lows in an uptrend. Very important to know. That is one. Then we also have liquidity resting above equal tops or below equal bottom. Liquidity also rests above equal tops and below equal bottom. So you have the market do something like this, like an equal top. What is resting above that level is liquidity, or equal bottom. What is resting below this level is liquidity. Right. And I will give you a general mindset of how to know liquidity is in an area. All right. Of course, the liquidity all over the market, even for this equal bottom and equal top, there's liquidity resting just around that areas I am marking out at the moment. But you see, price moves with respect to where the bulk of liquidity is. I'll talk about that just later. So there's also another form of liquidity called the trend line liquidity. Trend line liquidity. That means you see price moving more or less like in a trend. Now it's important to know that area where the retail traders can say this is a trend line. Liquidity rests in this example in this top side of the trend line. So price will usually break out of the trend line, grab that liquidity and decline. Also, if you have price going upwards, like in a trend line, akin to a trend line, liquidity rests in all of this trend line, but more importantly at the very bottom where the trend line began, price will just break the trend line, grab that liquidity, and expand to the upside. Are you following so far? So we are still identifying the areas of liquidity in the market space, and this is one concept that actually pull the pieces together for that will put the pieces together for you as a trader, as it did for me. Very, very important. Now also, there is liquidity resting above the previous day's high. Liquidity rests above the high of the previous day or the low of the previous day. Liquidity also rests above the high of the previous week or the previous week low. Liquidity also rests above the high of the previous session. You know, in trading, we have three sessions, essentially the London session, the US session, or the New York session, and the Asian session. So all of the highs or lows of these previous sessions, liquidities is resting above or below these sessions, and that is important. The previous day's high, the previous day's low, the previous week high, the previous week low, even the previous month's high and the previous month's low. This is so important. And why is liquidity resting above these areas? Because I have told you earlier that liquidity means fuel. It actually means money, which equates opportunities. Volatility, which also equates opportunities. Don't ever forget this equation. Liquidity equates volatility, and it equates opportunity. Right, so let's continue. So essentially, the way to understand all of these things, just in case you want to put this knowledge together, is that liquidity, right, represents money. Therefore, where the orders are placed in the market, you have the bulk of liquidity placed in these areas. By orders, I mean all of the orders you have in the marketplace, like your stop loss, your take profit, your buy or sell limits, right? Your buy or sell stops, your buy or sell limit, your buy or sell stops. You know, as a trader, that until your SL or stop loss is hit, you are not out of the trade yet. So until your stop loss is triggered, you have not yet lost a trade. Also, unless you close your trade very early, until your take profit is hit, you have not yet profited, or you are not yet out of the market. Until your buy limit, sell limit, buy stop, sell stops are triggered, you are not yet in the market. So what that knowledge means is that for someone that is buying, right, someone that is buying in this simple uptrend, their stop loss will most likely rest below that swing low, right? And the person will be in profit even though price is reversing or retracing. Correct, that is given. Now, until this low is taken out, the person or the trader is still in the market. So the market or the algorithm sees those levels. For example, in this little uptrend example, the stop loss of traders would be behind these swing lows, and until they get triggered, they are still in the trade. So all of those visual or psychological levels in charts are where you would normally put your stop loss, and so price would, in a liquid market, a liquidity hunting market, which we call stop hunting, price will essentially go take out those liquidities and pull alongside. Now that is very, very important. Now, of course, let me give you a little bit of twist into market structure. We have learned, or we know already, that market structure simply means the trend of the market. It's only you identifying the trend of the market, whether you are in an uptrend or a downtrend. So one of the things you learned in Forex 101 when you began your trading journey is to identify uptrends, that is higher highs, all right, and a downtrend making lower highs and lower lows. Now, you have seen it over time, if you have been trading for any length of time, that this is basic and very important. Yet a lot of traders don't understand how to know swings points in the market. I will not talk about that extensively today, right? You can maybe refer to the other video that is linked in this channel so you can watch that holistically in itself, right? However, the twist I want to do, because I am discussing liquidity, is to understand that there is a market structure that you can call advanced or algo market structure. And what that means is that, for example, in an uptrend, you usually see price do something like this: higher highs, higher lows, and then you will see price break that higher low and then continue to the uptrend, something similar like this. Now, note this area where price broke the higher low. A lot of traders will see this as a bearish momentum. So we are not quick to say a break of market structure is a change of direction, because many times that break of market structure you see opposite the movement or opposite the trend. Usually it is liquidity that is being grabbed, and the price will continue in the direction. Also in the downtrend, the same thing occurs. You have a series of lower highs, lower lows, and all of a sudden you see price take out the lower highs and then it continues in the direction. What just happened right there? Liquidity has been grabbed above that area. And if you can train yourself to only trade after liquidity has been taken from the market space, your profitability or win percentage will increase by astronomical percent. I'll say that again. If you would train yourself to only trade after liquidity has been taken in the marketplace, your trade percent profitability will increase astronomically. Now, in this video, I'm going to give you a lead into this and continue in the next series of videos on how to trade only from liquidity standpoint. So once again, if you have not yet subscribed to this channel and you're liking this, please give this video a thumb up, right? That's the only way you help to show that this is becoming helpful to you, right? And the algorithm will recommend this to other traders who are struggling out there. And please also do well to subscribe so you'll be notified immediately we upload the other series on liquidity. So let's continue. In this particular video, I will just give you a lead. There are going to be 4 scenarios or 4 patterns that we're going to learn in this series of liquidity. 4 of them. So in this video, I'll be giving you the first one, and that is what I drew in collectively, and that is when price does something like this. So this is scenario 1 or pattern 1, if you like. If you like pattern or scenarios, whatever that floats your boat. And this is it. You have price coming from a downtrend, and then it does this and then does this. Okay. Let me put this in context. I'm going to talk about this extensively in the next video, but this is what I want to show you, and this is a scenario 1. Actually, you have price do something like this in an uptrend, and it pulls back to take out this liquidity and expand to the upside. Now notice I drew this one first before drawing this. Now this area actually, right, is going to be like this. So but I want to give you a clean train of thought. So let's go again. So the first pattern, and the pattern we're going to be discussing right here, is price in an uptrend does something like this, right, and then pulls back, takes out this low and expands. Keep that picture in mind. Or in a downtrend, you have price does something like this and then pulls back, take out that high and continue. Now obviously this is just a part of an entire trade. You cannot open your chart and see something just like this. Okay, so when we look at chart examples, I will point out this thing to you. Remember, the train of thoughts I am giving, I want you to go with from this video, is that if you can train yourself to only trade after liquidity has been taken, your profitability will increase astronomically. So let's do that one final time. In an uptrend, you see price, right, creates a a higher low, expands and break market structure right there, BOS, right, to confirm the uptrend is still valid. And then price pulls all the way back and take out that low that started the move. Grab liquidity right there. You can put a dollar sign. Money has been taken. And once that occurs, there is volatility. Then you see price becomes volatile or expands after that liquidity has been grabbed. So I just tried to break the anatomy for you. So of course you have your BOS right there, and then there is a sweep of liquidity. Okay, there's a sweep of liquidity at the downside, right? So there's a break of market structure, confirm your bullish movement, and then price returns back to sweep liquidity and expands and expands and expands. Now, how do you trade this kind of setup? How do you trade this kind of setup? Usually, once this occurs, you don't expect that sweep of liquidity to be taken out again. Once this happens, you don't expect this area, right? Let me make it clearer. So you have price, you have price does this and expands. Now this area where liquidity has been swept becomes very, or you can call it a protected low. In this example, it becomes protected. So if you want to trade this setup, you can simply put your stop loss at that low, because that area had just taken out liquidity and your trend is bullish. So that low can be termed as a protected low. Do you get that? Now the simple way to trade this, right, is to wait for the pullback into either a fair value gap right here or an order block below. Usually, to help you, you can put your Fibonacci tool, right, from this high to this low, and then 50% of that fib tool. I'm going to give a quick example. 50% of that tool will be somewhere around that area. Okay, and then because you are looking to buy, you wait for price to retrace into the 50% or below, and that will be your discount zone. Again, we're not talking about premium and discount in this video. If you have not watched that whole training on this, please refer to the link in the channel or the video showing right at the top of your screen. Okay, now if you're liking this, please do well to subscribe. I don't know why I keep making that call, because that is the only way you will not miss out on the next series of videos, because this will be coming in series, right? So we have said that once you observe this pattern, right, where price sweep the liquidity to the upside, the way to trade it, you can simply put your stop loss right here, your valuation of the range, what's it called now, fib 2 will give you the midpoint. Let's say that's the midpoint right there. You expect price to pull back to at least below the 50% level. And how far will it pull back? If you have a fair value gap right there, you can start buying, right, so long as it's below 50%. Or if you have an order block right at the before the low right there, price can also come to the order block. You take your buy and you can mitigate your trade. That means you can take your take profit right there. This is a high probability setup, just trading liquidity, right? What will make this work? Number one, you have identified the trend. Are you bullish or you are bearish from the typical market structure? Now you have seen this example, you are bullish. The next thing is, can you see visually a sweep of liquidity to the downside? Can you see this pattern? Can you see this pattern we just drew right here? A sweep of liquidity, and then price has done that. Can you identify it? If you can identify that, the simple thing you just need to wait for is a pullback to the range, right? The other slant to this is when price breaks extensively, then you will not expect price to pull back here. It will just come back to a mitigation block right there and continue. We'll talk about that in our next series of videos. So let's go to chart example and put all of this knowledge together. I don't want this to be so long. We're already up about 18 minutes. So this is Aussie dollar 4 hour chart, and by the way, this works in any and every time frame. This works in any and every time frame. But you see, if you want to have higher probability, you want to use the higher time frame trade. By high probability, I mean less noise but high risk to reward trades will be trades you derive from the higher time frame. All right, so this is Aussie dollar. Obviously, what is the flow of the river in Aussie dollar? We are down in a downtrend, very giving. I mean, it is even the blind. I don't know if the blind can see this, but though it is, we are in a downtrend. Now let's identify within this downtrend the liquidities that have been grabbed based on what we learned today. So I'm going to zoom right in and try my possible best to show you what we talked about. Look at this downtrend movement. You see price pulled to the downside, rallied, pulled back to the upside, and then typical downtrend. Now look at this grab. Look at this price movement to the upside. Notice it took out that liquidity right there. Now this is exactly what I'm talking about, and once that occurs, you can see the expansion that followed, and then price did this one. Now you can safely say that high becomes a protected high. Why? It has grabbed liquidity, given based on what we are learning. Now you see the price does that, did this, did all that, consolidated for a while. Look at this expansion. Notice it grabbed this liquidity right there. That means sweep of liquidity occurred right there, and then every time that happens you see extension. Now it doesn't happen every single candle, from the 4-hour time frame, but notice the point I am showing you. These are reference points in the market that becomes protected or strong or strengthened, as the case may be. Right, let's continue. Now the one we marked out last right there, okay, you see our price expanded and then came back, took it out, did all that, and rallied. Doesn't this look like what we drew earlier? Okay, you have price doing this, comes down, goes back up to take out that high and expand lower. How do we say you have to trade this? We say you expect price to pull back to 50% and above. In this example, you sell off. Right, now look at exactly what happened right there. You see price created that high, okay, pulled back, rallied up to take out the high, did all it did, but it still fell off. So how do you trade that? Simple. We said bring out your fib tool. For in this example, right, I'm going to bring out my fib extension and evaluate the range. Notice where I'm evaluating the range from the high to the low that was taken out. Right, let me give you that lead. Very important, and it's simple, very easy. That's the high that got taken out. This is the low that also got taken out. So evaluate from the high to the low right there. All right, and then mark at the 50% level. Expect price to pull back to above the 50% level, and I said how far will it pull back to? An order block or a fair value gap. So you see price pulled back to this order block, right, to that. This series of down close candle is an order block. So you see price pulled back right there and decline. Very simple. What made this trade idea powerful is that we see liquidity has been grabbed in the up and the downside. Just to help your mind, that's why we have that pattern this way. Okay, how did I put it now? That's why we have the earlier pattern, the one pattern we are learning in this video, and that is this price took out the high and goes lower, right? And then we say we expect price to pull back to the range and then decline further. I hope that makes sense to you. So I don't want to keep repeating myself. You can actually refer back to the earlier part of the video, but what I'm doing right now is to evaluate the range. So you can see that high. I'm going to take the fib tool to the low right there and then bring out another tool. Oops. Okay, let's do that again quickly. Put your fib tool at the high and then extend it to the low. That is, you're evaluating the range. Okay, now I don't do this all the time. This is just if you don't know how far price will return to. Mark at the 50% level. So I expect already that this pullback will go above this level. How far will it go to? I can see series of order block right here, and if I want to trade off liquidity, I would simply be notifying, or my eye will even be at this high right there. That price can easily take it out and expand. But other than that, all of this order block, then all of this fair value right there, price will come back, fill them, and decline. So with one breath, I just gave you a nice powerful setup. Right, now in this particular example, you can clearly see that price did, like I told you again, in the next series of video I will explain how to trade clearly off liquidity. You can see price took out that liquidity. Okay, so what does this mean to me? Amongst other things, even though I know price will have to come back here and decline, something can also strike my mind, and that would mean you can actually look for opportunities, right? Because it's a 4 hour time frame. Once this has occurred and you expect price to pull back to certain level, right, you can actually look for buy opportunities to the upside. In fact, this past week we did take trade like this. Finally, look at the same Aussie dollar. You can see what price is doing for with this pair at the moment. We see price created this liquidity, and then it has taken it out, or it took it out right there and declined to take out all of this low. Oops. Price declined to take out all of this low. Liquidity grab has happened there. So similar thing. But in this case, we expect price to pull back to, we expect that high now to hold. All right. And then we're expecting further decline. Now I can go on and on and on. I don't want to mumble up all of the ideas for you, right? So the first we're able to identify is the grab of liquidity within the market structure, and we said once you see that occur, you have a high probable setup that is forming, right? I would have loved to go into the trades we did take out this past week from GBP USD and gold. I will rather do that in another video to prepare your mind for the whatever week, whatever time you're viewing this, to prepare your mind to know how this trade works. Again, they are not 100% in the market, but note my use of language: high probable setup. Now, as I conclude, if you're having a problem to trade your account and you feel you need trade signals to help you filter your trades, like you can currently see video of our trade signal room just scrolling across the screen at the moment. Now we have a trade signal room that shows you what to do within the market, not just the buy here, sell there typical signals, but also gives you pictorial view of what to expect in the market. It's showing you where we are at and where we are headed. Very beautiful stuff. And usually this goes for $60 per month, but for my beautiful YouTube subscribers, you can join in for just $30 per month. Just $30 per month. Now this is a limited offer, I think just about for 20 persons or thereabout. So I don't know when you are going to be watching this video. If you are interested, simply hit interested in the comment section, or I will leave in my WhatsApp number right there. All you got to do is to send me a message on WhatsApp, all right, and request, just say you are interested and ask if there are still opportunities for you. If the slot is still opened, right, for just 20 persons, we are going to let you in for the $30 per month signal room. Now it's guaranteed of giving you at least 500 pips every week. All right, this is what we've been doing for the greater part of 7 months, and the results are astronomical. If you're trading a prop firm or whatever you trade, this will work for you. So again, if you're interested and if the offer is still open, you don't have to, right? But if you want to, please send me a message. Once the 20% gets completed, this will be off the table. Usually it's about $60 per month, but for my YouTube, I'm doing this for just 20 persons, right? So it's a discount of 50% discounts for 20 persons, 20 of you. So if you're interested, send me a message and see if there is still slots available, and I will add you in the Telegram channel so you can start trading profitably week in, week out. Other than that, please do well to join in our next video. We'll take this a notch higher and it gets better. Once more, if you have not subscribed, please do that right now and like the video, share to others to come learn the concept of liquidity and market structure. I'll see you in our next video. Okoli signing out.